The spotlight in the Eurozone sovereign debt crisis turns once again to Spain, where Prime Minister Mario Rajoy is set to present his struggling government's draft budget for 2013 on Thursday. Joining me down the line to discuss the situation is Nicholas Spiro, Managing Director at Spiro Silver and Saturday in London. Hello Nicholas. Now, the euro dipped before 1.29 against the dollar for the first time since QE3 was announced, as investors await a potential bailout request from the Spanish government. But what impact has the uncertainty had on Spanish bonds, especially in light of this morning's auction?
Well, what we've seen certainly in the case of this of the bond auction this morning, it was an auction of short-dated debt, so it was actually a bill auction. We've seen rising in investor nervousness about Spain, and this is clearly showing up in slightly higher yields. What's worrying is that it's even the yields on short-dated paper which are actually rising. Now, you would think that it would be that segment of the market which given the fact that it's actually benefited most from the ECB's conditional pledge to purchase unlimited amounts of short-term debt, you would be hoping that this is the segment of the yield curve which would be fairly resilient. But obviously, this most important thing for Spain is that it was able to get its debt out the door this morning. But what I would say is that the only reason why demand for Spanish debt is actually holding up is not because of an improvement in sentiment towards Spain. It's because of an improvement in the credibility of an ECB-backed fiscal backstop for Spain.
The government is expected to remove a tax break for home buyers and to introduce a tax intended to curb carbon dioxide emissions. Many analysts are expecting more austerity measures, but what are your predictions from the budget?
This would be the fourth or fifth round of belt tightening in Spain we've seen since the Rajoy government came to power. I mean, Spain needs further austerity like it needs a hole in the head. The economy is in a dreadful state, and any significant additional belt tightening on top of what's already in the pipeline is unlikely. I think that there is certainly going to be a more refined, should we say, they're going to put some more flesh on the bones, and there's going to be a slight tightening of fiscal policy. But all of these measures are already planned. These are the measures for the coming years. What we'll see certainly on the fiscal side is a reaffirmation of the government's commitment to bring down the deficit. We'll probably see more on the structural side. I mean, all of these measures are basically, this is a negotiating tactic on the part of Madrid to retain as much ownership of its domestic reform agenda before it seeks a bond buying program, which we believe is almost inevitable given the scale of Spain's financial and economic real estate related problems. It's almost a given.
Mr. Rajoy has pledged to cut Spain's deficit to 4.5% of GDP in 2013 from 6.3% this year. In your opinion, is this figure achievable?
We believe that a bond buying program for Spain is practically inevitable. It's priced into the market, and if you do the math, you see that Spain will certainly need some form of external assistance. And more importantly, it's now becoming increasingly clear that Spain is going to have some serious problems complying with the conditionality of any possible bond buying program. It's going to struggle to bring its budget deficit down this year, any level under 8%. The 4.5% target, which you've actually mentioned for next year, is entirely unrealistic. And the problem is now becoming not so much the willingness to actually request a bond buying scheme, but the ability of Spain to comply with any extra conditions that are demanded of Spain. In order for Spain to be able, in order for the Spanish economy to be able to keep its head above water, there needs to be a fundamental rethink of fiscal and economic policy in Spain.
Friday will see the release of a report showing how much additional capital Spanish banks will need to maintain safe reserves. Oliver Wyman has published a preliminary assessment that banks will need as much as €62 billion in additional capital just to stay afloat. Do you agree with this figure?
I think it's fairly realistic, and the problem is not so much what the provisioning requirements and what the recapitalization requirements are now, or at least when Oliver Wyman finished its analysis. The problem is that Spanish bank restructuring is pretty much a moving target. The goalposts are constantly shifting. The economy is in a virtual freefall. So the moment that estimates are actually presented, there's always the risk that, in fact, they are not up to date and that they are going to have to be revised. The problems in the banks are not only related to the property sector. They're also related to the retail sector, to utilities, to manufacturers. There's a lot of categories of loans which are now suffering. And the most important thing for Spain is to ensure that the financing of the bank restructuring is in fact going to be taken off its books, so that basically the shoring up of the banking sector doesn't further erode the creditworthiness of the sovereign. It's breaking that feedback loop between the banks and the sovereign, which is absolutely essential in order for the Spanish sovereign to be able to fund itself.
Nicholas, thank you so much for your insights today. Well, sadly, that's all we have time for at the moment. As usual, the Dukascopy TV team will bring you exclusive interviews and fundamental analysis to keep you up to date, so please do stay tuned. Bye for now.